All right, we have more changes unfolding in U.S. credit markets and in the swamp of Washington, D.C. Changes that saw the first weekly outflow of U.S. Treasuries in more than 6 months, breaking the longest and largest weekly inflow record ever, which means that the tables have officially turned, and higher for longer is finally beginning to sink in to investors' reality. A reality that for the last 18 months has been fighting the Fed every step of the way, refusing to believe their hawkish rhetoric. Well, it appears that that's now changing. We're going to look at what just happened, what this means for yields going forward, how much higher they'll realistically go, because a lot changed last week and will affect rates on everything across the board, from our mortgages to credit cards, lines of credit for your business, student loans even. And we'll also look at this new temporary stopgap that Congress just passed through, what it includes, but more importantly, what it's missing and how that could help exacerbate global volatility in the coming weeks, as the next 3 months are gearing up to be, well, interesting. But before we get started, press the like button and subscribe. It's all I ask for in return for making these videos. It helps me out, and I appreciate your support. So Congress, folks, the United States House of Representatives, a middle school filled with geriatrics, voted and approved a stopgap bill, or what they call a CR, a continuing resolution, a temporary funding bill that keeps the government open and running for another 45 days, at which time all this just starts all over again. And if you weren't keeping up on the minute-to-minute down there yesterday or the day before, as the negotiations were being finalized, Republicans trying to read the last-minute changes and Democrats trying to stall the vote, something that happens all the time in Congress. Well, one guy, Representative Jamal Bowman of New York, pulled the fire alarm. Caught on camera in the act, really is like a geriatric middle school, just embarrassing. So what's in the bill, folks? Well, we don't know exactly what's included, but we do know for sure that more Ukraine aid was not included, which means expect an escalation in Ukrainian doomsday talk in the coming weeks, as the powers that be want Ukrainian aid. The Speaker of the House, a Republican, the Senate leader, a Democrat, and the President of the United States are all dead set on sending more of our money to fund their war effort, something that is expensive and inflationary and is fighting against the Fed's policy tightening. War is always expensive. Ukraine's no exception. And U.S. military spending now close to surpassing $1 trillion annually, all paid for by borrowing. Fiscal excess is clearly the theme of this decade. The Biden administration, for example, proposed a $6.9 trillion budget, folks. $6.9 trillion in spending just to keep our government open is what they wanted to get passed. The Republicans in Congress prevented that, leading to this CR to pass yesterday. This is what fiscal excess looks like, what we're spending in order to just keep the lights on, not for some sort of crisis or bailout, just to stay open and in business. 44% of our annual GDP. And don't be mistaken, this isn't 44% of tax revenues. We're spending 44% of our annual GDP. We've only done that 3 other times in history, all times of great crises: World War II, the Great Financial Crisis, and of course the pandemic. Well, we're doing it right now just for fun, for the hell of it. During the Trump administration, they passed a $1.3 trillion spending bill in 2019. At the time, everyone thought it was crazy. That's before COVID happened. So we went from $1.3 trillion to now $6.9 trillion. I mean, talk about long-term inflation. So with all of this happening, the funding bill being signed 2 nights ago, that means let the Treasury auctions commence. The borrowing continues, and this comes only 2 weeks after our country's national debt crossed $33 trillion. Well, here's where it gets interesting. For the last 6 months, each and every week, there has been a net inflow to U.S. Treasuries, the longest such streak on record. Investors have been flooding into safe U.S. government bonds and out of riskier assets. And even with all of that demand for U.S. government debt, it still hasn't been enough to keep yields from moving higher, significantly higher. Well, that's officially ended. Last week, something changed. After Jay Powell's last press conference, bond traders and investors who've been going long on U.S. Treasuries have had a change of heart, let's say. After all this time planning to wait the Fed out, wait for lower rates, well, it looks like they've waited long enough. They blinked and have begun selling a net $3.6 billion outflow last week, and rumors abound that the Fed's not playing around, and they very well may mean it when they say higher for longer. Now, is that the case? Is the Fed really in it to win it this time, in it for the long haul? I don't know. I doubt it, but there's most definitely been a shift in bond markets, which means this imaginary cap that we've been experiencing with rates where the risk premium hasn't increased anywhere near where it normally would has been lifted, and yields are now rising. Here's what Bloomberg says. The article's titled, "Once Unthinkable Bond Yields, Now the New Normal for Markets." Written yesterday or 2 days ago, September 30th, they write this. It was the week that bond markets finally seemed to grasp what central bankers have been warning all year. Higher interest rates are here to stay, from the US to Germany to Japan. Yields that were almost unthinkable at the start of 2023 are now within reach. The sell-off has been so extreme, it's forced bullish investors to capitulate and Wall Street banks to tear up their forecasts. Now, we've talked in previous videos how nobody seems to believe the Fed, unlike in previous tightening campaigns where the chairman was able to wield substantial influence over markets. Well, this time around, let's just say Jerome Powell hasn't had the same effect on people. They go on and write, yields on 10-year German debt are close to 3% now, a level not reached since 2011, and the U.S. equivalent is back in line with the average from before the global financial crisis and within striking distance of 5%. And realize what that means. The 10-year crossing 5%, it's a big deal, folks. Once it crosses, it's likely to shoot right past it. That 5% number is like a fake imaginary border, a key resistance level that's been holding rates at bay. Bloomberg says this. The question now is how much higher they're going to go, with no real top in sight after key levels were broken. While some argue the moves have already gone too far, others are calling it the new normal, a return to the world that prevailed before the era of central bank easy money. The implications stretch far beyond markets to the rates paid on mortgages, student loans, and credit cards, and to the growth of the global economy itself. Now, one person who's riding high right now is Bill Ackman. 2 months ago, he said he's shorting long-term treasury bills. He also called for his base case that the 30-year would hit 5.5% and said it will happen sooner than later. Well, it's not quite there yet, but it's getting close in spitting distance now. And if the 10-year were to break through 5%, it could happen shortly thereafter. Take a look at what he just wrote about this on X. He published this September 21st saying this: I believe that long-term rates, the 30-year rate, will rise further from here. As such, we remain short bonds through the ownership of swaptions. The world is a structurally different place than it was. The peace dividend is no more. The long-term deflationary effects of outsourcing production to China are no more. Workers and unions' bargaining power continues to rise. Strikes abound, with more likely to come as successful walkouts achieve substantial wage gains. He goes on, our national debt is $33 trillion and rising rapidly. There's no sign of fiscal discipline by either party or by the presumptive presidential nominees, and each debt ceiling is an opportunity for our divided government and its most extreme actors to get media attention and for our nation to threaten default. This is not a good way to recruit the many new buyers that we need for our bonds. Now, I don't know about you, but he sounds spot on to me, especially with that last line. Listen to this, though. He writes this: I bumped into the CIO of one of the world's largest fixed income asset managers the other night, and I asked him how it's going. He looked like he had a tough day. He greeted me by saying there are just too many bonds, a veritable tsunami of new issuance each week. I asked him what he was going to do about it. He said the only thing you can do is step away. Now that is spot on, folks. We've been talking about this since last year, that there's just not enough buyers, regardless how much demand there may be from hedge funds and portfolios. It doesn't matter because the buyers are just too small to make a dent in the supply. It's the case with government debt across the board and with MBS, mortgage-backed securities. You see the pattern here, right? The Federal Reserve stopped buying our debt. In fact, the Treasury is even selling MBS right now, all the mortgages that they acquired from those bank failures earlier this year. But the main problem is all the money that we've borrowed in recent years, subsidized by the Fed, is now sitting out there, drowning the markets in supply. It's mind-boggling that rates are as low as they are still. And on top of that, China is now a net seller of U.S. debt. This is the time to prepare for higher rates, folks, something Bill Ackman obviously agrees with. This is what he predicts will happen. He writes this: I have been surprised at how low long-term rates are. I think the best explanation is that bond investors thought of 4% as a high rate of interest because rates hadn't breached 4% for nearly 15 years. When investors saw the opportunity to lock in 4% for 30 years, they grabbed it as a once-in-their-career opportunity. But today's world is very different from the one that they've experienced up until now. The long-term inflation rate plus the real rate of interest plus term premium suggests that 5.5% is an appropriate yield for 30-year treasuries, and query whether a half point is sufficient real long-term rate in an increasingly risky world. And the technicals could cause yields to go even higher, particularly in the short term. We saw the beginnings of that today. Now, that was written on September 21st. Well, 10 days later, and a whole ton of selling in the bond market last week, accompanied with a whole host of new debt our government just agreed to take on, start preparing for higher rates across the board in the short term. All right, if you enjoyed this video, got something out of it, press the like button. If you didn't, that's all right too. Either way, I appreciate you watching.